Welcome back guys, and welcome to another Zero DTE video. Today we're going to talk about the difference in high and low probability strategies and how to not lose all your money. If you're interested in becoming a pro trader and learning all the tips and tricks that you might need, check out the link in the description for a 4-week trial. Enjoy guys.
That old strategy, the one that most people are trading, the at-the-money iron condor with the 5 delta wings that gives you that supposed 95% probability of profit, ain't working. It's not working because in getting that high probability chance of making a tiny little profit, you're taking on huge risk. Now, you may not hit that risk, that mungo risk, but there's nothing but downside once you get off of that profit side. Once you start getting out of the center of that strategy, you're in the red, right? And you're in the red in a big way. And because of that, they have to take extra precautions or special considerations in the course of that strategy. And what do? Well, they take that 95% probability of profit strategy and they totally turn it on its side by putting in stops that equal 3 times the potential collected premium, or the premium that you could collect, and thereby turning a 95% probability strategy into a 65% probability strategy, still with the same kind of gamma risk. That makes no sense. And you don't increase your profit potential either. So what that is doing is it's creating a really untenable situation, one where it makes it impossible for you to scale this type of strategy. You cannot take this from a small account to a big account. Sure, you might make tiny little wins here and there along the way, and then you get this big bam, sets you back 2, 3 weeks, 4 weeks. That bam could happen 2, 3 times in a row, and often does, wiping out an account. That never happens in our strategy, can't happen. So let me give you an idea of what the difference is between a high probability strategy and a strategy like ours that is focusing not on win rate, but on return, right? Where the risk is very small, the potential profit is very large. All right, these are all the previous sessions that we have. Every day there's a live session in our trade room. And so we go through all of this whiteboard sessions. There's just hundreds and hundreds and hundreds of them. So you're gonna get quite an education when you join our service. But what I wanted to show you was something very telling here. Oh, here's an example, one right here. So this middle picture that you're seeing right there, that's a bell curve. And as you can see it, there's the bell curve and there's your one standard deviation. You're probably very familiar with that. What this is showing right in the middle is 0, and over here is positive profit, and over here is negative profit. So what a bell curve is showing is a distribution of all the returns that you have, right? So if you had a perfectly normal distribution like this one in the middle that I'm showing, you would have an equal number of big wins and big losses. So you wouldn't really get anywhere. So that's not the way most people trade. Well, some people do, but they don't get anywhere. A high probability strategy is designed so that you have small wins and a lot of small wins and potentially some big losses. So it is like what we see up here at the top, high probability. So to the right, here are the wins. There's a bunch of small wins, as you can see, some small losses, and then some big losses. That's way out here. They call this left-leaning or left-skewed long tail. Now, the problem with a strategy like this is that the only way to get these small wins into big wins is to dramatically increase the amount of risk that you take on. Currently, with a strategy like this, you're typically putting on, say, $1,000 of risk to make maybe $50. In order to make $500, you have to put $5,000 of risk on. You have to put dramatically huge risk to make relatively small amounts of profit. That is not a scalable strategy at all. On top of that, you're subject to these huge losses way out here that can wipe out your account. Now, what we do is more like this, the winning strategy, where we have a right-skewed long tail distribution. So we have a bunch of tiny losses offset by some tiny wins and then augmented or stair-stepped, or what increases our capital and our wealth, with some medium-sized and huge winners. Now, this strategy you can scale because our risk to reward is more like $10 to make, I don't know, $500, let's say, as an example, right? So that's more typical of what we do. Now, this type of strategy you can scale. This is scalable because now you could easily take that risk portion and say, yeah, I don't want to take $10 risk. I'd like to take $100 risk. Now, instead of going after 500, you're going after 5,000. That's really the difference. You can scale this strategy. You cannot scale the other strategies. This strategy will never get you into trouble. The other strategy will eventually, mathematical certainty that it will get you into trouble.
Thanks for watching, guys. I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks, guys.